Welcome ladies and gentlemen, my name is Chris and on behalf of Paul Elmsley, the founder and CEO of HealthCert, it is with great pleasure that I welcome you and thank you for taking a time out of your busy schedules to listen to the first in our series of medical business management webinars. I'd now like to introduce our speaker for today, Dave Hodge. Dave is a qualified accountant as well as having a degree in psychology. After an 8-year career in some of the largest corporate financial services companies around the country, Dave founded Vital Additions with 4 divisions. These incorporated tax, CFO, wealth and advice. With a focus on small to medium enterprises, particularly in the health, medical and creative industries, Dave's team can handle anything from restructuring to ongoing advisory and helps customers to make informed decisions to drive growth, manage the return on investments and enjoy peace of mind on all matters relating to their businesses, taxation and compliance.
Thanks, Chris, and thank you guys. Listen, for everyone who sat through that the debacle the other day, my apologies. Unfortunately, life on the road, sometimes these things happen. I had some car trouble and had to duck into a cafe hotel, and it was as painful for me as I assume it was for you guys. So hopefully we should have a better wrap today. Now, team, what we decided to do with this case study, Vital Addition, we've got 4 different divisions: tax, CFO, wealth and advice, as I said, and we were conscious that there are other partners in the masterclass program that do parts of what we do. So we're going to stick today on the structuring side of things, and again, we're acutely aware there's a huge array in the audience: practice managers, doctors, all sorts of different varying levels of knowledge. So stick with us. What we've tried to do is use one of our case studies of a live client, live practice, where we cover as many different strategies as possible in one hit. Now the guys at HealthCert have been kind enough to allow us to have another session in a few weeks, so we'll certainly look at the feedback from what you guys have given us and then also recut that with something a little bit different. So let's get stuck into it, guys. So the background here was a medical practice in Goulburn. The turnover was $3.5 million. There was a staff of 12. It was structured via a proprietary limited company, and the shares were held in the personal name of the principal and his wife. Now I'll just pause on that point for a second there, because this is probably the most common restructuring issue that clients come to us, whether they're doctors or other industries. Now in your industry, guys, most of you will have already got some level of advice and understand that we have to be very careful when it comes to income splitting, those sorts of things. So for the medical industry, holding shares in your personal name is not actually about income splitting and necessarily reducing your tax. It's much more around the asset protection side of things. So making sure that if something goes wrong within the practice, and that could be anything from one of the practice managers making a mistake with a client booking, one of the other practitioners making an error, it doesn't really matter, but it gives you some level of protection by not holding the shares in your name, and we'll get to that structure a little bit later. The second element of this restructuring for the client was that they owned a commercial property, and it was owned in his name. In this situation, the commercial property was actually the premises of that the medical practice practiced in. He also had 2 partners in that commercial property, so we had to consider that. This particular principal he was in his late 40s, and he'd accumulated 8 residential properties in his own name as well as his wife's, and we'll get to it a little bit later what the challenges were there. He also had a principal place of residence, so PPR. Principal place of residence, for those that don't know, it's just a tax term for the house that you live in, the one that you own. He also had that in his own name. Alright, so guys, I thought what we'd do here is, as I understand, some of you prefer to learn visually as well as those that prefer the dialogue, so we're trying to cover both bases here. So if we're doubling up, my apologies, just bear with me. So you can see here that the top box, ABC Proprietary Limited, is the medical practice. So that company held the shares in the principal's personal name. You've got the commercial property here in the middle. Again, the commercial property was held in the principal's personal names. And then the investment property, sorry, that should say 8, not 9. Over here you've got the home residence in their name, okay? And you can see here, essentially all the assets that they'd accumulated were being held in the individual's name. That's the point to take out of this. All right, so the issues that we faced in this situation, the first one is we had a large amount of non-deductible debt. So basically what that means, they were paying interest on a mortgage, being their home residence, and they weren't getting a tax deduction for that. You know, and some of it depends on how much your mortgage is, and for those of you that have paid off your mortgage, obviously that's no longer an issue. But coming back to the essence of why we do these case studies, guys, it's not necessary to hit each individual personal issue for you. We're trying to put a broad brush stroke out there, and the key message is talk to your accountant. You know, ask him these questions. If you've got any non-deductible debt in your name, doesn't really matter what it is, it's certainly worth a discussion to see if that can be restructured back into a tax-deductible way. The second side of this was a high level of risk exposure for the assets, both business and personal. So that's what I was talking about before. By holding your assets all in your individual name, if something goes wrong within the business, something goes wrong personally, and it doesn't necessarily need to be, you know, a professional indemnity issue. It might be that something happens in your personal life. You know, you're injured and can no longer work, and for whatever reason your personal insurances aren't in place. If your asset base is large enough and your debt position, you know, is also large enough, and you haven't got any income coming in to service that, you risk losing all your assets. So it's not just about your professional practice, guys. It's a full look at your personal as well as your business structuring to ensure that you've got protection as you're building these assets. Okay. Now, one of the things is, you know, most people in Australia, when they purchase a property, they don't get any advice up front. Right? So they purchase the property in their own name in order to get the tax deductions. Now, there's nothing wrong with that, but the point we want to make is that as you accumulate 3, 4, 5, 6, 7, 8 properties, we need to be careful about where that sits in relation to where your income's going. So it may be that it's okay to have it in your personal name, but we have to make sure that the debt within across those assets is high, so that if you do get sued, you're not going to end up losing out on that. The third part here was this high level of tax being paid. Now, bear in mind this particular practitioner had a number of other practitioners working within the business, and they weren't just doctors. They had physios, chiropractors, you know, a few variations on that. So it truly was a business. You know, so all of the income didn't necessarily have to flow through to personal services income. So we had some flexibility there, which feeds into the last point: tax-effective distribution of profits. And as I mentioned here, there are other doctors involved as well as some other practitioners outside of the medical world. Now, guys, we focused on these issues because they are the most common issues that we get asked questions about by our medical practitioners. So, you know, absolutely there will be other issues within these types of strategies that need to be dealt with. And again, looping back, just making sure you're asking the question, is my asset structure right for me? And what does right for me mean? Well, when you start out, it's very different to 5 years in, 10 years in. If you acquire practices, if you bring in other patients, you know, there's so many trigger points that can you know, lead into a change in asset structure. So the point is, it's not you guys aren't, you know, you can't be expected to know the rulings and how it all works. But if something changes within your personal or your business life from an asset perspective, it's well worth asking the question. All right, so this is what everybody wants to hear. How do we actually fix this? So I'm going to quickly run through this. I might actually jump this slide and go straight to the diagram, because it can get a little bit curly with talking straight into it. So what we did, guys, and the key here is you've got your principal place of residence, so the home that they lived in. So this particular doctor had a couple of $1 million home and had quite a bit of equity in it because he paid it down, but still had 600 or 700 grand worth of debt that he wasn't getting any interest tax deduction on it. Okay, so that's an important point there. So what we did is then we established this family trust, right? So that's really the trigger point, you know, and moving forward, that is the baseline position where he will hold all his future assets, whether it be shares in the stock exchange, artwork, whatever it is. Anything outside of his self-managed super fund will go into here. The reason we use a family trust is for two reasons, particularly from an investment point of view. Firstly, it defeats creditors, or potentially defeats creditors, if there's an issue within the business. So as the name suggests, it's a discretionary trust, and it's at the discretion of the trustee as to who gets the assets and the income. Now this is really powerful when you've got an issue where you've got creditors coming after a trust. They can't actually go any further. The other side of it is a family trust gives real flexibility around distributing profits. Again, outside of the personal services income tax for you doctors, from an investment point of view, it's a great vehicle because it does allow you to flexibly distribute profits to your partner, to your kids. There's a few different ways of looking at it. So now that we've set up that structure, what we actually did was we went back to the bank, and obviously the principal and his wife were the beneficiaries of the family trust. We actually incorporate a corporate trustee as trustee of the family trust. The reason being is that if something happens to one or two of the principals, it's a lot easier to make changes to the trust if it's a company. If it's two individuals, it can be quite tricky. So we set up that structure there. Then we went back to the bank and said, listen, we want to draw down some equity on the principal place of residence to filter through to the family trust to then use that money to invest. So we helped with the principal. We actually helped with their mortgage broker, provided the right information, bank accounts, all that sort of stuff, profit and loss, balance sheets, and got that loan. Once we got that loan, the money was now sitting in the family trust here. So the family trust used that money to buy the shares, remember, that were previously sitting in the individual's name. So remember this company here, the individuals had the shares in their individual name. Well, now the shares sit in the trust name, right? So the money comes across here, shares go back that way. So this, now you've got over here, you've got a lot of money sitting in the company. So that money then needs to be distributed out to the shareholders, and the shareholders in their individual names then filter that money back down to the principal place of residence and pay down the non-deductible debt. So you can see it's just a cycle that goes around like this, right? So that the two things, the major things that have changed is the principal place of residence is now, the interest being paid on that is now tax deductible because it's for the shares up here. So let's just take a step back and take a minute to talk about that. The ATO looks at interest and what is the principal amount of money being used for, right? So in this case, from the family trust, it's being used to purchase shares. Therefore, the family trust can get a tax deduction on the interest. So we've got to be really careful on this sort of stuff, guys. You've got to get some advice around these types of structures because if you make a mistake, the ATO can look pretty dimly on that. So this could certainly help out from that perspective. Okay, so I might actually skip back now and go back to the solution now that we've talked about the diagram. So you can see there the trust has gone to the bank account and has got funding for the acquisition of the shares under the PPR as security. Again, we helped out with that. The sale of the shares in the company from the private name to the family discretionary trust, and then the trust paid the shareholders who then used the funds to pay down non-deductible debt. It is worth mentioning at this point, guys, that it's highly likely that this type of restructuring will trigger a capital gains event in the company. That's absolutely fine. There's what's called the small business CGT concessions, which may potentially apply to that. So there's an opportunity to restructure tax-free. Again, it entirely depends on some variables within your business, and your advisor should be able to advise you on that. All right. So the outcome, guys, was pretty simple. It meant we had a non-deductible PPR debt, which is the home loan debt, was now deductible as a loan against the purchase of the shares. The asset protection of the business assets. So now that the shares sat within the discretionary trust, to put a layer of protection around that. And in this particular instance, because you had the distribution of profits, wasn't just around the doctor doing personal services work, it was now available. So there's a couple other points I just want to touch on, and I'm going to go back to the initial diagram on that. So we've dealt with the shares, okay, so we've restructured that. We don't have enough time today to go into detail around the commercial property and the investment properties, but what I will say is that particularly for the commercial property, there's a whole different structure that we use for this particular person. We set up what was called a property trust. Now, some of you might have heard of unit trusts. So a unit trust is a fixed unit setup, so that there might be 100 units issued in a unit trust, and depending on how many units you have, that's how much of the asset, capital and income that you're entitled to. So we rolled this commercial property out of their individual names into a commercial property trust, of which he then had the minority of the units held through his discretionary trust, right? So feeding back again, the family trust, discretionary trust, held the units in his property trust so that it was tax effective, and that was able to split income, plus it was able to protect the assets. And a similar sort of juncture for the investment properties. Again, guys, I know the guys at HealthCert have been kind enough to say they're going to send out these slides. We've done our best to keep them really simple and really high level. Always happy to talk further into these, or if you've got specific questions about your situation, it's just a flick an email and we can always have a chat, or talk to your own advisor, of course. Alright, so guys, that's just my details up there.